Welcome back to Pietros Maneos Finance. Tonight, I'm going to be talking about a company, Yanzhou Coal Mining, which is a holding of mine. And one of the things I try to do here on this channel that I feel distinguishes it from others is I don't want this to be purely a personal finance channel where it's just kind of generic advice like, invest in index funds, invest in a Roth IRA, spend less than you earn, all the kind of like personal finance channel stuff you'll get, right? One of the things that I think is different here is I run several $1 million. I run about $1 million in real estate, and I run over $1 million in equities. And so I really want to show process of someone who's doing that, because I feel that you guys can learn a lot more from seeing the process than just from like raw motivational stuff. So that takes me back to Yanzhou Coal Mining. This holding reminds me a lot of a young Warren Buffett. And why is that? Well, for those of you who have done a deep dive into Warren Buffett and his style of investing, in his early to mid career, he would do something called cigar puffs. And a cigar puff was he would incessantly scroll through Moody's looking for undervalued companies. And they may not have been great companies, but they had one cigar puff left in them, meaning they might have been trading for under net asset value, meaning if you stripped the whole company apart and sold everything, it was worth more than what its market cap was. So, but maybe they were in a dying industry or what have you. So they were just these cigar puffs. I'm not necessarily saying Yanzhou Coal Mining is a cigar puff 100%, but many people feel that, with the transition from sort of old economy things like coal and oil, and one might even say natural gas, to renewables, that coal is on its way out. Plus, you have a lot of negative sentiment, from hipsters, environmentalists, people like that, who don't want to touch it, even if it's a great investment. Endowment funds, for example, they may be banned from owning it. I've made a lot of money recently in Yanzhou Coal Mining, and a close friend of mine, Logan Kane, he writes for Seeking Alpha also, and we were on a phone conversation, and he said to me, "Where the heck do you find these companies? Yanzhou Coal Mining, right? Everyone's looking at Apple and Tesla and Palantir and Altria and all that. Yanzhou Coal Mining, right?" But that's, I'm a hunter. I'm always hunting, and I'm doing that through screens. So the way I found it is I do a screen in Guru Focus. I can also do the same screen in Fast Graphs. So I'm going to pull over here, and the screen is a basic one. I'm searching for things that are unloved to make contrarian plays. So how do I do that? I search for things that are PE 0 to 10, dividend yield 2.9 or above. The earnings per share, you could throw in the 6 or just leave it blank. But so what you're going to find here are you're going to find companies, the stock market is, what's the P? It's like 25, 30, even above that right now. So you're going to find companies whose price to earnings are under 10 and they're paying a dividend above around at least a 3% dividend. So AbbVie, we're going to just kind of go through this list. Let me bring my screen down a little bit. So we're going to see, what jumps out here is AbbVie is one. We're just going to go through this quickly. So this is what I do. I go through here. So Bank of China, look at that. It's PE is 3. Its dividend yield is 13. That would be a super Maneosian. Own it. So we're just going to go to the next page here. Nothing really jumps out there. Just we're doing quick. So Cardinal healthcare company, China Mobile I own, but then it was delisted. So that's an issue you have with, Chinese stocks right now, the sort of geopolitical. China Construction Bank, own that. PE 4.25, dividend yield 5.87, also a super Maneosian. Remember, a super Maneosian is something that's truly unloved. It's when its dividend yield is higher than its price to earnings. A regular Maneosian is just where the P ratio and its dividend yield, it's a ratio of 2 or under. So let's just go through a few more. So I go through these screens, I go through Guru Focus, I go through Zacks, I go through Fast Graphs. Camping World is on here. That's Marcus Lemonis, right? So Dow, that's actually in the dogs of the Dow, the DOW ticker. So we're in the D's here. I'll go through a couple more. First United, First Horizon I also own. So you can see I've picked up a lot of these over the last few years. But let's go to the last page here. So you'll see on the last page is Yanzhou Coal Mining right here, the last entry. Its price to earning is 5.39 and its dividend yield is 4.21 on this screen. So it's not quite a super Maneosian, but it's definitely a Maneosian. Look at its earnings per share yield, 18.54% here. So let's go here and actually we'll go over here first. So this is a little video I pulled up on YouTube, and this, you can see the title of the video is 9 biggest mining companies in China, and you can go ahead and pull it up. It has about 3,000 views. But you'll go through the list here and you'll see, so the names, so you'll see China's Shuenshu Energy, China Coal Energy, Zing Mining Group, and we're going further down. And the largest one on this list is Yanzhou Coal Mining. And it says, this company mostly operates on coal businesses such as producing fine coal, blown coal, power coal, and coal chemical products. It also operates other businesses such as power generation, railway transport, machinery manufacturing, and heating businesses. In the third quarter of 2019, the company's revenue reportedly reached $44.63 billion. I have an expression that I've used in private, and it's that power is power. And so you look at what's the largest company in the world, Saudi Aramco, bigger than Apple by, you can look at different metrics by earnings, by market cap, so on and so forth. But generally Saudi Aramco is regarded as the largest company in the world. So companies that are producing energy, creating energy. I mean, you could even argue the mania in Tesla is not just because of the cars, but because of the solar and the batteries that they're working on. And again, power is power. Those who produce and control power do well and earn profit, and then profit can translate into political power and so on and so forth. But look at Gazprom. I mean, Gazprom in Russia, the whole Nord Stream 2, right? That whole brouhaha with America and with Germany. So this is a highly profitable company. China uses a lot of coal. And so you can go ahead and watch this video if you wanted to kind of see about all the others as well. And let's go here. So again, this is just on, and I pulled it up just on different sources here. You can see here, it's not showing its P on this one, but it's a 16.34 billion market cap, 4.98 here is showing as its dividend yield. And then you can see I started buying it, and I'm going to show that to you in a second, when it was right in the 13s. But you can see over the last 6 months what it's done. I mean, it was at 10, 11. I started buying it in the 13, so it must have been probably around here. I mean, I'll show you in a second. Look what it's done. God, look what it's done since August 20th. It went from 1227 to 1877. So it's really jumped up. I personally think it still has room to run because of its low price to earnings and valuation. So now what I'm going to do, I'm going to go into a new software that I purchased, Fast Graphs. One of the cool things I like to do now, I added this to my process. Again, so I'm talking about process here. So even when I do screens now, value type screens like that to find unloved equities, I'll now take it into fast graphs just to verify the information that I find on a lot of screens. So we're going to go here. Okay. Now, this is a great example. This is McDonald's. Okay. Now, I'm not going to get into the nuts and bolts of fast graph. I'm going to leave that for the excellent investor and owner, founder of Fast Graphs, Chuck Carnival. But to bring it to the most basic level, you see the blue lines and the orange lines. Those are sort of the blended P, the intrinsic value here. If the black line, which is the price, is above the blue and the orange line, it's generally considered overvalued. If it's trading underneath the orange and the blue line, it's generally undervalued. And the further it is away from those two lines, if it's on the lower end, the more of a margin of safety, to quote a Benjamin Graham and what might even say a Warren Buffett statement, that you would have. So this is McDonald's. Let's just take, before we do Yanzhou Coal Mining, let's take let's take Microsoft. Just kind of see what that would be like. Wow. Okay. So you look here, you look at Microsoft. It's way above the blue and the orange line. Now, if you go back, it looks like in, 2013, even into 14, you could have bought its intrinsic value, so you could have gotten the growth. Even in 17, you could have bought it at sort of the P that it normally trades at. But after, once you start getting into end of 2017, it's really trading above its value. So on a big market crash, you could be all the way at the top here, coming back down to here or here even, okay? So you don't have that margin of safety. It doesn't mean you can't make money. It doesn't mean it won't go from here over all the way up to here, right? Markets can be irrationally exuberant. They can be in a mania and so forth. But generally, when you employ value investing, fundamental investing, you generally want the line to be under the blue and orange. So that is Mike. So we looked at McDonald's, Microsoft. I mean, most people will tell you that the market is generally overvalued. So it's tough to find bargains in a market that's overvalued. But let's pull up our good friend, Yanzhou Coal Mining. Look at that. Look at that margin of safety. You could see here, it was trading above, this is in 2014. But look at now, from 2018 on, basically. And you can see, the little run up it had here, right? Even from May 1274 to 1877. But look at that margin of safety that still exists. So even your entry point today, you're still having a tremendous margin of safety there. So that's a cool tool that I've been using recently. I picked it up before I even had this tool, just from the screens I was looking at. It was showing up on a lot of different value screens. But now I'm going to take you into my TD Ameritrade account and show you my actual gain from this. So you can see Yanzhou Coal Mining. My purchase was on April 19th, 2021, 84 shares, 1308 for a total of 1,098. Okay. The value of that 1,098 today is 1727. It's showing a gain of 515, but it's actually more than that. This is another little learning moment here for people. The return that TD Ameritrade is showing is, I would say, incorrect, but they actually include the 6646 and the 4711 as a cost basis. Okay. I don't view that as a cost base. Those are dividends that came off that were reinvested. For tax purposes, it would count, I guess, as a cost basis. But I look at it as, look, I had $1,098 in my checking account. I transferred $1,098.95 in order to purchase 84 shares of Yanzhou Coal Mine. That's my cost basis. Any dividends that come off, to me, it's part of the total return. So $1,098.95. So right now that $1,098.95 is worth $1,727.81. So we're gonna say, so my gain from April until now is $628.86. Okay. Now, let's do the return, because it's showing my return here at $515, not the $628.86, and it's showing a 42% return, which is amazing. But it's actually even higher than that. So the way we get that, the total return number, is we would want to do 198.95 times X is going to equal 1727. So the math on it is 1727.81. And we're going to divide that by 1,098.95. We're at minus 1. So my actual return is 57.22 above the 42.50. I mean, they're both excellent, 42% or 57. You could argue, and say that, oh, well, the dividend is a cost basis. I don't see it that way. I see I purchased this amount of shares. That's my cost basis. But even look at even the reinvested dividends. Like my cost basis on August 13th, $66. That's 83. This my cost basis is 47.11. 60. It's worth 62. So even these are up $21, $15, 32% return. So even the reinvested dividends. But yeah, so that's Yanzhou Coal Mining. It's an out of favor sector, coal, in an out of favor country, China. It's the most unloved of the unloved that you can get, right? It's a total contrarian play. It's not Tesla, it's not Palantir, it's not a Cathie Woodstock, it's not some Silicon Valley tech IPO. It's coal mining in China. But look at the return. And now a lot of people would say, oh, take a profit here. But because of the fast graphs, you can see there's still, I feel, and the math shows essentially the weighing machine, not the voting machine, but the weighing machine shows that there's still room to run on Yanzhou. And for me, this, even if it were to go back to intrinsic value, these things I might just hold forever or hold for a long period of time because it pays a dividend. So you're just, by reinvesting dividends, compounding and compounding. I mean, if it got way overvalued, maybe I would just take a profit. I mean, if it started trading, I bought it at 13, it's trading at 18. Say it went to 50 and it was looking like the McDonald's, right, that I showed you on Fast Graphs, way above intrinsic value. Maybe I would take a profit there, perhaps. But anyways, that's it for tonight, Friday night. Not out and about, partying, sitting in my study talking about a Chinese coal mining company, right? Almost at 500 subscribers, getting a lot of people from Asia, which is cool, like actually China, Pakistan, India. So a lot of those different countries are tuning in. Appreciate it. All over the globe. Take care. Have a wonderful weekend. Ciao.